Hello and welcome to this session in which we will discuss the PCAOB and the SEC independence rules. In the prior session, we looked at the AICPA independence rules. What is the difference between the two? When we discuss AICPA independence rule, we are referring to auditors that audit private companies. When it comes to PCAOB and the SEC, we are dealing with auditors that audit publicly traded companies, which are called issuers. Issuers, PCAOB, non-issuers, which are private, AICPA. Remember, independence is the cornerstone of auditing. Why? Because when a CPA performs an audit, there are three parties involved in this process. We have the CPA themselves, we have the company, CPA 1, company 2, and we have the users of financial statements 3. Now the company or the client hires the CPA and actually pays the CPA to perform an audit on the company, the audit on the financial statements of the company. However, the intended users of the financial statements are a third party. So although the company, party 2, is paying the auditor, which is party 1 is issuing financial statement to the public, to the users of the financial statements who's supposed to be the public. Now the users, since they have no relationship with the auditor, they have no relationship with the CPA, to trust the CPA, they have to perceive the CPA as impartial. They have to trust that the CPA is independent. They have to trust that the CPA is objective. And the CPA must be independent in mind and appearance. What does that mean? It means they have to actually be independent in fact, in mind. And also when it comes to appearance, they have to appear. They have to look like. They cannot look as if they are advocating, although they may not be advocating, but the appearance alone might tarnish your independence. The PCAOB is the audit of the auditors. So who audits the auditor? The PCAOB. Audit the auditors that audit who? Public companies. Why? Well, the PCAOB came after the Enron, WorldCom, the frauds that took place, and the government says the industry, the CPA industry, the auditing industry, when it comes to public companies, they cannot audit themselves. We're going to be auditing them. And they audit you once a year if you audit more than 100 publicly traded companies, and otherwise once every 3 years if it's less than 100 publicly traded companies. So in this session, we're going to be looking at the rules that involve both the PCAOB and the SEC, because they both deal with public companies when it comes to independence. Why do we worry about independence? Again, independence is the cornerstone of auditing. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. First thing, we're going to look at prohibitive services. Prohibitives means services the auditor cannot perform when they are performing an audit. Otherwise, they would lose their independence. Their independence will be impaired. And those rules are by Sarbanes-Oxley. When I say Sarbanes-Oxley, what we say is the same thing as PCAOB, because the PCAOB is the creation of the Sarbanes-Oxley Act. And also the SEC, they have their own rules, and they limit your services for companies that you are auditing. So those are non-audit services, and those they cannot be offered when you are performing an audit. Financial information system design and implementation, bookkeeping and other accounting services, appraisal or valuation services, actuarial services, internal audit outsourcing, management or human service functions, anything that management you can do, broker, dealer, investment advisor or investment banker service, legal and expert services unrelated to the audit, or any other service that PCAOB determines by regulation is impermissible. Now, in this list, what's missing is tax, and hopefully you notice this. Can we provide tax services? Well, let's talk about the tax services. Tax and other non-prohibitive services. Tax services, can you prepare the tax return for example, the corporate tax return for an audit client or their state tax return? Well, you can, as long as you get the pre-approved by the audit committee. Who's the audit committee? We're going to talk about the audit committee shortly. So as long as you can get the approval, because tax services is not a prohibitive service. So notice, tax service is not one of these services. These services, that's it, you cannot perform. However, since tax services is not prohibitive, you need to get approval. So if something not prohibited, you must get approval. Tax, for example. Now, you cannot prepare the tax return for company executives who oversee the financial reporting. Simply put, you can prepare the return for the company, but you cannot be too friendly with the executives. Now you start to have a financial relationship with the executives. You can't do that. No tax avoidance planning services. So although you are preparing the return, you are not helping them do planning. Planning is different than preparing the return, especially aggressive planning. Planning is what? Planning is when you're trying to save them money. Well, if you're trying to save the money, you are advocating for the client. You can no longer be independent. You have to be in bed with them. You have to be on the same page, because the goal here is to save money. Of course, legally, nevertheless, you're no longer independent. CPA firm is not independent if the audit partner receives compensation for selling services to the client other than audit, review, and attest services. Also, you cannot sell them, because if you're trying to sell them, you're trying to convince them. And when you try to convince them, well, you might be subordinating your objectivity and independence. And what else do you need to do? You need to disclose in a proxy statement or the annual report the breakdown of fees for the past 2 years. So how are you getting the fees from the client? Because as users, we want to know. And this especially becomes important after Enron. I'm going to tell you why in a moment. How much you are getting for audit fees, audit-related fees, tax fees, and all other fees. Why is this relevant these days? Post Sarbanes-Oxley, for that matter. Because Enron, when Enron was being audited by Arthur Andersen, 25 million of the fees that they were charging, 25 million was for auditing services and 27 million was for consulting services. So Arthur Andersen was receiving 27 million from Enron for consulting services and only 25 million for tax services. So simply put, what's going to happen is this. Well, Arthur Andersen was basically paying Enron $1 million per week for tax and consulting services. And because the consulting services represented a larger portion of tax, well, they have some undue influence. They can twist Arthur Andersen's hands in agreeing with them on certain things. So that's why you have to disclose how much are you getting paid for tax, non-tax, audit, so on and so forth. We mentioned in the slide that you have to get approval from the audit committee. The audit committee is an important component of the corporate governance. Let's talk about the audit committee. Sarbanes-Oxley legislation mandate the establishment of an audit committee within a public company. So what are we looking at here? On the top, you have the board of directors. Within that board of directors, you want to have an audit committee. This audit committee, you have to have it for public companies. This audit committee is the party that hires, compensate, and supervise the auditor. Remember, the auditor is auditing the company. The company is management. You don't want management to hire the auditor. You want someone else. You want the audit committee to hire the auditor to audit management. Although management technically is paying for the auditor, but they don't hire the auditor. This committee also holds the authority to resolve any conflict arising from financial reporting disagreement between the company and the auditor. So if there's any disagreement, you don't have to go to the company. Although they're paying you, you go to the audit committee, who's supposed to be independent. And all significant finding discovered during the audit will have to be communicated to the audit committee. The audit committee, as I mentioned, must be independent. The composition of the audit committee could be 3, 5, 7 members. They have to be independent. It must be exclusively comprised of members who have no affiliation with the company's management. That's why those are the people you're going to go to when you find an issue with management. Also, The audit committee includes at least one individual that possesses expertise in financial matters, aka, a CPA will suffice. Now, who are the covered members? Who are the people who they should be very careful when conducting an audit for a public company? Very careful in terms of independence. Well, in any individual that possess the ability to impact the audit and their immediate families. Who are they? Well, people on the front line, members of the audit engagement team, individuals holding position capable of influencing the people on the line, the staff, the senior, the manager, the partner, people in the firm's hierarchy. Partners and managers offering more than 10 hours of non-audit service to the client, and partners within the office of the principal partner responsible for overseeing the audit engagement. Simply put, partners and managers within that office that are providing more than 10 hours non-audit services. Non-audit services is tax services, for example. Now, what are some independence issues that could arise that we have to deal with? Those issues are very similar to the AICPA issues. So sometimes I'm going to say this is just like the AICPA. The assumption here is you looked at the AICPA. Otherwise, go ahead and look at the AICPA independence rules. We're going to look at ownership interests and financial interests, partner rotation, conflict arising from employment relationship, and shopping for accounting principles. I have partner rotation twice, which is called opinion shopping. Starting with ownership interests. Just like AICPA, covered members cannot have any direct ownership, whether that material or not. Simply put, just like the AICPA, no direct ownership. Indirect ownership, it depends on the materiality. So for direct ownership, materiality is not an issue. For indirect ownership, materiality is an issue. Loans. Can you get a loan if you're auditing a bank? Well, similar to the AICPA rules, normal lending procedures, that's fine. If you have a collateral, that's fine. Can you have a savings or checking account at that institution? Yes, as long as it's less than the FDIC protection amount, the Federal Deposit Insurance Corporation. In other words, you have no interest to fudge the numbers for the bank because the money that you have in the bank is protected by the government. Credit card balance, you can't have that with that bank less than $10,000. How about if you received stocks from gift or inheritance? They're called unsolicited ownership. Just sell them. You have 30 days to get rid of them. You will be in good shape. Shopping for accounting principle could impair independence. And what does that mean? What does it mean, shopping for accounting principle or shopping for an opinion? Here's what happens sometimes. The client, which is the company that you're auditing, they may seek guidance from a different CPA regarding some issues, some accounting principle issue. And here's what happens sometimes. The company might be happy with that new opinion. So in the event that the client decides to switch auditor following the given advice, the newly engaged CPA might uncover fresh information that necessitate a revision in their position. So they left auditor A, they went to auditor B. So let's just, rather than A and B, let's assume their current auditor is PwC, and they went to KPMG and they asked KPMG about their opinion. The KPMG gave them an opinion about an accounting principle. So KPMG is the new auditor. Well, they were happy with their opinion. They said, okay, thank you very much, PwC. Now we're going to hire KPMG because we liked what they told us. Now, once KPMG got on board, they find out that there are more information, more facts and circumstances that their initial opinion was not 100% accurate. It was accurate based on the information that they had at that point. What would happen? What would KPMG, the new CPA now? Okay, this could lead to a potential compromise of their independence because the new CPA provided an opinion without being fully aware of all the relevant details. So it's essential. What should KPMG have done? What should KPMG have done? They should have talked to PwC. They should have talked to the PwC to just kind of consult the CPA firm and establish communication with them, the current auditor, because they might give you more information about the situation. And obviously you have to get the client's permission. If the client don't allow you, then you have to be very careful in whether you want to take them as a client or not. Okay, so this action is crucial to gather all the relevant facts before forming a judgment. Matter of fact, as a future CPA, as a future auditor, Stay away from giving an answer on the spot. Always you want to take a look at additional fact, additional circumstances. Always qualify your answer. This is the answer, but. Always that's the case. This is the answer, but under different circumstances, this is not the same answer. Okay? This approach means communicating with the current auditor will minimize the practice of seeking multiple opinion to manipulate outcomes. Because why are they asking me for this? For this information if they already have an auditor? We want the second opinion, that's fine. Give them a second opinion after you consult with the current auditor. No problem. Employment relationship. Very similar to the AICPA, hiring former members of the audit team within the audit client organization gives rise to independence issue. So if you hired, an auditor, they switch team, well, there's an independence issue. An auditor who transition into roles such as chief CEO, controller, chief financial officer, chief accounting officer, or comparable position can encounter conflict of interest. The SEC says, well, you have to have what's called a cooling off period. Okay? Basically, you have to just wait a year. Well, can you be hired? You can be hired, but you should not be working in key financial reporting position. Maybe work in marketing for a year. Then they can take you back and put you in the financial reporting position. Otherwise, the employment relationship is similar to the AICPA rules. Partner rotation, what does that mean? It means the lead partner and the concurrent audit partner, they have to step away from the engagement every 5 years. So you can be on the engagement for 5 years, then as a partner, not as a firm, as a partner, you have to leave, wait 5 years, come back, and you could be the partner on that engagement for 5 years. Initially, it was the firm have to leave, and there was a lot of disagreement that, well, if you let the firm go, then they need to hire a new firm. There's a learning curve. It takes time, it costs money. Therefore, what they agreed on, well, the lead auditor and the partner will have to leave every 5 years, basically bring new partner, new sets of eyes. Let's take a look at this multiple choice questions from Farhat lectures. Which of the following statement is true? So one statement is true regarding the audit committee of public company. So since one is true, 3 must be false. So it's easier to spot the false statement. Okay? Let's take a look at option A. Most audit committee are made up of 3 to 5 directors who are part of the company's management. Most audit committees, they could be formed of 3 to 5 directors. They can be directors who are part of the company management. No way. They cannot be part of the company's management. Directors means it's just a title. I'm not saying director for the company. If those directors are part of the company, that's a no-no as well. Simply put, the audit committee cannot have any relationship with management. And what makes this answer incorrect, false, is part of the company's management. We can cross A. That's easy. B, the audit committee should have at least 2 independent members. Oh, no, no, no. Not at least 2. The audit committee, all the members should be independent. Okay? So B is out because they all need to be independent. The audit committee is responsible for the oversight of the work of the auditor who is appointed by management. Well, the audit committee is responsible for the oversight of the work of the auditor up to this point. 100% correct. Who's appointed by management? Not at all. Management cannot appoint the auditor. C is out. By process of elimination, D is the answer. Let's make sure D is the answer. The audit committee should include at least 1 member who is a financial expert. Yes, at least 1 member. And we say CPA because we take pride in our work. CPA is a financial expert. So 1 person is a financial expert, at least 1 person of a financial expert. They all have to be independent, but at least 1 person is a financial expert. Independent means they have no relationship with the company. In other words, they are working objectively. They have no financial interest in the outcome of the audit, of your audit opinion. Otherwise, if they are, then again, independence is violated. The whole purpose of this audit is to make sure we give an objective opinion. What should you do now? Go to Farhat lectures, look at additional MCQs, true, false. That's going to help you. Whether you are an accounting student or a CPA exam candidate, invest in yourself. Good luck, study hard, and of course, stay safe.